Hey, this is Tom, and I have a major warning to every single investor out there. The biggest question on everybody's mind right now is whether we are gearing up for a crash, whether this is the first cracks of the AI bubble popping, and whether this is the right time to get out before it's too late. Today is a super important video because the right time to set up your portfolio and prepare and strategize for potential problems is when the market is still in a bullish cycle. And despite all this hoopla and all this talk about a crash, we're not even close to that yet. But here's the point. That is exactly when you want to start prepping for the inevitable correction or maybe even a crash. You want to be doing that when things are good. You want to be doing that when the market is still in a bullish cycle. You certainly do not want to be doing this after the market started crapping itself. So this is why I'm here today to teach you how to handle this, how to prep your portfolio, and how to be ready for whatever happens. We're not going to be predicting anything. We're going to be preparing, and today you're getting everything absolutely for free. There's no paywall, there's no nothing. Let's get to it. So right now, if you pop up in the fear and greed index, you're going to be shocked to find out that somehow, despite a huge bullish cycle for the past 3 years, we are at max fear at about 22. We have to make sense of this. And the one thing I want you to be is calm. Because I've explained to you, yes, we're still in a bullish cycle. We have plenty of time to prepare and strategize. There is no rush to do anything. We will be calculated and slow. But I don't want you guys to be complacent, because the flip side of what I'm seeing right now is people getting too comfortable. A lot of people right now are saying, well, Tom, I'm not even stressing out about it. I'm just here for the long term. I don't mind what happens. Everything is cool. The problem is that if you started investing in the past 15 years, you really haven't seen a normal market. What you've seen is mostly a very bullish cycle, one big bullish cycle, with two minor V-shaped recoveries in 2020 and 2022. Pretty much, that was it. Basically, if you're in this game since 2010 and onwards, you haven't seen something that's called a U-shaped recovery. A recovery that doesn't bounce back right away. Not 2 months like in COVID, not 10 months like in 2022. Like in 1973 when it took 2 or 3 years for the market to bounce back. You certainly haven't seen, God forbid, a W-shaped recovery. A recovery that fakes as if it's a V. It bounces back up. Everybody gets wrangled back into the market. And then the inevitable crash happens, catching everybody for the second wave. In 2000, with the W recovery, we went minus 50 for the first time. We recovered all the way back, and then in 2008, we went minus 57 again, losing a whole decade with no gain whatsoever. Now, most investors are absolutely not ready for a W or a U-shaped recovery. Let's be honest about it. Let's not lie to ourselves. They're not ready emotionally, they're certainly not ready financially, and they don't have the strategy in mind how to deal with these risks. And let me be clear here that just hoping it's not going to happen or saying, hey, it's unlikely, the probability is very low, oh, I hope it doesn't happen. It's not a strategy how to handle this. You got to be prepared. And the good news in this video, that's exactly what I'm going to do. I'm going to prep you like you've never been prepped before. You're going to have everything, every single tool you need to make it happen. Now, there are good news here because the system I'm about to teach you today, which has about 4 parts, has never failed in history. In fact, it even worked in the lost decade of 2000 to 2009. When people followed the system in the lost decade, they still made a whole lot of money. Now, how do we get to the system? How do we get to this point? Well, it's very simple. We start with step 1. Before we run, we have to be able to walk. Before we walk, we have to be able to crawl. And step 1 is crawling. Step 1 is understanding that 90% of investing is emotional control. Not me saying that. Warren Buffett, Charlie Munger, and a lot of the greats have said that 90% of investing is all about emotional control. But the problem is people are still looking for this secret sauce, the technique, the DCF chart, the model, the investing system that can't fail, and they won't do work on themselves emotionally, which is where everything starts. Even if I give you the best investing strategy of all time, the best tools, the best DCF, the best teachers, if you don't have emotional control, none of this is going to help you. None of this is going to help you. This is all window dressing. You have to be internally set for this. Otherwise, it's not going to work. And it's not an indictment against you or against other retail investors. We are all the same. We're all emotional creatures. Whether we'd like to admit it or not, human beings are emotional. And if you understand that and you accept that as a feature, not a bug, you understand how to plan so that doesn't impair your judgment. Let me give you an example. You're not going to be taking your ass outside of a pizza shop at 1 a.m. after you haven't eaten all day when you're drunk. You're not going to be putting yourself in a position where you're about to make a bad decision. You are making all the right steps ahead of time so that isn't your reality. You go to bed at 8. You eat orderly during the day. You don't go to the pizza place at 1 a.m., etc., etc., etc. You wouldn't put yourself in a position to fail. The same thing has to happen in the stock market. So how do you do that? What's the equivalent of the pizza shop analogy in the stock market? It's quite simple, actually. Stop checking your trading app every single day. Stop checking the news about the stock market every single day. Stop reacting to noise every single day. Stop looking at price swings on the daily or even on the weekly as if it matters at all. Think of the stock market and specifically about your portfolio and the companies in it as a business. You are a business owner. Write down your potential failures. For that, you got to be honest with yourself, right? So you got to admit that you're flawed, which is hard for a lot of people, but certainly we are all flawed creatures. Make a list of everything that may derail you. All the possible mistakes you can make, all the possible misjudgment, everything. Write it down. Because when you have it down, number one, you're going to be better at avoiding it. And number two, when fear sets in because the market does some crazy stuff in the short term, this list is going to prevent you from panicking. Number two, pretend that you're advising somebody else about your portfolio. If somebody else had that portfolio and they were asking for advice, what would you say? It's a lot easier when it's a third party to be honest versus being honest about yourself. Number three, you have to track your emotional fuck-ups and screw-ups. Every time that happens, you have to journal it, you have to debrief it, and you have to learn from it so it doesn't happen again, just like the military does. Number four, write down when you buy and when you sell a stock. Why did you buy it? What were the reasons? And why you decide to make that purchase or that sale. It's very important. Number five, I have no internet. You know how you go on a trip and you're in the mountains in Montana somewhere, you have no Wi-Fi, you have no signal, so you can't check financial news app and all this stuff? Pretend that that's you. Pretend that that's you from 9 a.m. to 4 p.m. every single day. Do not check price swings. Do not check mainstream media. Do not check financial, social media, none of this. Pretend you don't have internet. Your life is going to be a lot cleaner, a lot simpler. You don't need it. You're not a day trader. You're not a high volume, quick trader. You're a long-term investor for the next 20 years. You don't care about the daily price swings. The next step is all about insurance. Now, people don't like buying insurance. I get it. You pay a huge premium and then you pray never to use it again. It's the most disgusting deal you can imagine, but insurance is still a massive business because everybody needs it, right? In the stock market, it is the same. If you're up a lot on a stock like Palantir, on a stock like NVIDIA, and we can pull up right now NVIDIA and Palantir on Stock MVP, stock-mvp.com, use the code BF35 for a 35% discount for a lifetime of use. On Stock MVP, you can put in any stock into the scorecard, and what you'll find out with Palantir and NVIDIA, they both score 90 out of 100. These are the two highest scores we have ever seen in Stock MVP. Everything about these companies is perfect. Every single fundamental data point, whether it be free cash flow margin, whether it be operating margin, revenue growth, cash to debt, anything you can think of, these companies are wonderful. The only thing that prevents them from getting a perfect 100 is the PE ratio. It's higher than 30. That's how we define the test, which basically means it's not selling at a discount. But nevertheless, wonderful companies. If you've made money on Palantir, on Tesla, or NVIDIA over the past few years, and now you're sitting on a huge amount of unrealized profits, it would be foolish not to trim 10%, 20%, even maybe 30% so that you can lock in these profits without taking yourself out of the game. We're not talking about liquidating. We're not talking about abandoning your thesis. We're not talking about stopping being bullish. We're talking about insurance, a little trim on the big unrealized gain, and you're still in it at 70, 80, 90% in the game if it continues to run. It's just smart, prudent behavior, and don't let your emotions try and sway you from that. Because in bull markets, the investment horizons stretch to infinity. But when things hit the shan, you know what things I'm talking about, when the feet hit the shan, all of a sudden that long horizon of investing shrinks to basically 1 week. You don't want to be in that situation. Protect yourself, protect your capital, trim a little bit on your biggest winners, especially in a hyper bullish market like we have right now. Another thing you have to do is protect your capital. And that means that whatever's going on with the market, you always have to keep about 10% of your portfolio in the vault. A vault being maybe cash, maybe other things. A lot of my students like the cockroach portfolio, where they have 25% gold, 25% in bonds, 25% cash, and 25% in uber safe stocks. The cockroach portfolio is not designed to make you money in the bull market. Not at all. In fact, it's designed quite the opposite. But in a complete collapse crash, it's not going to do nothing. It's going to protect your money. So 10% of your portfolio in the cockroach portfolio or similar structure is just smart, prudent behavior, because still you have most of your money still betting on the bullish cycle, but that's just defense. Now, number 4, which is the pinnacle of the system, is tactical accumulation. Once you have emotions down, once you understand each possible scenario, V, W, U, once you bought some insurance through the cockroach portfolio, through trimming your biggest winners, now you get rich slow, okay? Not quick, slow. Warren Buffett once said, everybody wants to get rich. Nobody's willing to get rich slow, even though it's actually pretty simple, okay? We basically do that by continuing to invest a fixed amount, no matter what, at the same stocks we have, no matter what the weather is, whether it's hot, cold, snow, shine, rain, wind, whatever, we continue to buy at all times, and we benefit from drops in the market. Basically, this system turns fear and panic into money, turns fear and panic into profit, okay? We have a monthly investing plan, and then we actually utilize the drawdowns and the corrections to make more money. Now, the way it works is quite simple. It's called the 50% DCA rule, and I'm going to give it away right now. I'm not shy about it. I'm not trying to promote anything or sell anything. I'm giving it away for free. So basically, you make a budget, and you figure out how much you can invest every single month. For somebody, it's going to be $100. For somebody, maybe $100,000. For the sake of our example, we're going to use $1,000 just because it's a round number. Now, if you can invest $1,000, does it mean you have to invest $1,000 every month? No. That means you're deploying half of that amount, $500 every month, as long as the market remains normal. Once the market goes and drops 20% below the 52-week high for a stock and 10% for a broad market index like the S&P or like the NASDAQ, then you take the money that you always kept on the sideline when you invested $500 instead of $1,000, and now you're dipping into that, putting in $1,500 instead of $500 until the market corrects back again and it slows down again. And vice versa, when the market flies up 20% of the 30 days, you slow down to 50% speed. And you invest $250 until it actually goes back and basically goes to normal, whatever normal is. This system essentially gives you a weighted average of the cost basis of your positions, very close to the low, very close to the lowest point they've ever been, without timing the market even once. So if you control your emotions, and if you do this system of insurance and this system of double down DCA over the long haul, the next 20 years, the system cannot fail. It simply cannot fail. It only has one Achilles heel, one failure point, and that is assuming you pick the right stocks. If you haven't picked the right stocks and you've been dollar cost averaging into trash, the system ain't going to help you. The premise here is that you've picked good companies to invest in, multi-decade compounders, that now they're going to reward you after 20 years investing. Now, for that, I also have a solution. I invite you to join my academy, patreon.com/Dom Nash, ROIC Academy, where we teach investors how to evaluate companies, how to select the best stocks for their portfolios, how to be a judge of business quality, of fundamentals. We don't give you stock picks, buy alerts, sell alerts. We will teach you how to pick the right companies for you, for your portfolio, your risk, your profile, your preference, so that you can thrive over the next 20 years investing the right way. Would love to see you there. Thank you so much. I'll see you next one. Peace.